Hello everybody, welcome back to another video. In today's video, I will talk about drawn liquidity. And I think this is the most important topic that I will share with you guys, all right? Now, first thing first, this is my personal approach. This is the way I am finding my drawn liquidity, all right? Some people have different approach. This is my personal approach, and this is basically what I'm doing every week. All right. So let's get it. So, what is drawn liquidity? Drawn liquidity, or bias, in other words, is used to understand the probable market direction and identify the most likely targets based on the time frame you're analyzing. All right. Me personally, my drawn liquidity is on the weekly time frame since I am an intraday trader. All right. If you're a swing trader, you want to use the monthly, or if you're a scalper, the 4 hour. All right, etc. Me, I'm using the weekly time frame. All right, because most of the time I am trading the 1 hour and the 4 hour CRT. All right. It is the most important aspect of your analysis and should be your top priority in trading. If you don't have a clear drawn liquidity, you're not trading, all right? You will simply blindly trade without a drawn liquidity. You need to have a clear vision on where the price is going on the higher time frame. This is important. All right. All other ideas, setups, and narrative revolve around a clear understanding of drawn liquidity or bias. Without understanding drawn liquidity, you are simply doing pattern trading, which is the worst approach. Like I said earlier, all right? Now, the importance. The first and most important role of drawn liquidity is that it helps you understand what the market wants to do and which direction is likely to take rather than the direction you want it to take. This eliminates emotional and sentimental bias, keeping your approach focused, mechanical, and objective. All right. So, for example, you want the price to go up, you're focusing on buys, but in reality, the drawn liquidity is bearish. All right. This approach is not good when you want to trade based on what you want the price to do. You will get wrecked. You always need to have a clear drawn liquidity to make sure that you're positioning yourself with the right direction. All right. If some example, um, you are on Bitcoin, you buy at like 100K, and you want the price to reach 120K, but in reality, the price is going to 80K. All right. You will force trades. You will say, oh, there's no way I'm taking a loss. I want the price to reach 120K. But in reality, you have some clear key levels. You have a sweep liquidity, for example, and price starts to see some bearishness based on like market structure or whatever. You should just take your small loss and go on. So with the right drawn liquidity, you will always be properly aligned with the market, significantly improving your trading decisions. It helps you avoid unnecessary setups that may seem attractive but go against the natural market flow, saving you from potential losses. Example, you're bearish, the price start to pump heavy. You said, all right, this is it, to the moon. In reality, this is just a big retracement. All right. Drawn liquidity allows you to position yourself with more confidence, knowing that you are trading with alignment with the market order flow. It simplifies the decision making process by reducing the numbers of conflicting signals, allowing you to act with clarity and conviction. All right. This is a filter, guys. For example, you're bullish. All right. You see two opportunities during the week. This is better than taking 5, 6, 7 trades, shorts, long. You know, you're reducing the numbers of signals. And when you do this, the accuracy will be better. You're risking less and you're only focusing on A plus setups. All right. Now, we have the short term drawn liquidity and the long term drawn liquidity. The short term helps identify where retracement profiles or smaller movement might potentially end. All right. For example, when trading intraday, the short term drawn liquidity helps pinpoint where the market will likely make its first move, such as a liquidity purge, like a turtle soup, an initial target before making the major move. So, if you guys know, for example, you're bullish, you know that Monday, Tuesday, or Wednesday have a 80% chance of making the low of the week. So if you're bullish, the short-term drawn liquidity helps pinpoint where the market will likely make its first move. So for example, you have your short-term drawn liquidity and price reach it on Tuesday. You can say to yourself, all right, so that's a classic expansion week incoming. And this might be the low of the week. All right. This allowed traders to anticipate short term price reaction before the bigger trends. All right. Now, the long term drawn liquidity. The long term drawn liquidity focus on major movement and expansions, helping traders see where price is heading from a broader perspective beyond short term market reaction. All right. It is used to understand where price is likely to go with a larger narrative. Perfect. So, on the daily, weekly, monthly, this is where you want to look for your drawn liquidity, guys, most of the time. All right. With the long term drawn liquidity, you will know where price will go on the higher time frames. All right. This perspective helps traders align with the higher time frame order flow, improving the ability to capture big market move. So the market profiles, for example, you're in a retracement profile. Now price start to expand. So if you have a long-term drawn liquidity on top, then you want to focusing on buys all the way to your drawn liquidity. All right. The long-term drawn liquidity is for expansions and the short-term drawn liquidity is for retracement. Keep that in mind. Now, the types of forms. So we got highs and lows, CRT high and low, higher time frame PD arrays, so order block, fair value gap, breaker blocks, rejection blocks, all right, and the 50% of a dealing range or an expansion range. Yes, this is, for me, this is a drawn liquidity, all right? So you have the short term right there. Sorry, this is in French. And this is the long term. Now, this is, for example, a weekly time frame. Knowing that you have a short term drawn liquidity right there and a long term right there, all the way to this point, you can focusing on sales. All right. And then when you see that, for example, there's a CRT right there with the Model 1 and then price break the structure. Now you can say to yourself, all right, I will focusing on buys all the way to this point. So example, you're here, all right? And you said to yourself, oh, my drawn liquidity is right there, so I'm focusing on buys. Be careful because, for example, this is a week right there. This week might be bearish. So you want to focus on sales, even if the higher time frame drawn liquidity is bullish. And this is why it's important to know the importance of time, such as a quarterly theory or open, high, low, close, whatever. All right. This is important because you might get trapped because in 1 month, if you're bullish, the whole month's not going to be bullish. There's going to be like 1 week or maybe 2 weeks of bearish price action. All right. Keep that in mind. So for example, here you got the order block. All right. Order block. Now, this is a weekly time frame. For example, here we reach this order block right there and then price close like this. In this week, you can say, okay, this is the next point. Even if your drawn liquidity is there, look how the candle close. So open, high, low, close. The next candle must be bearish. So you want to focus on sales all the way to this point. Sorry, all the way to this point. All right. Now look at this picture. You have a drawn liquidity right there. All right. Price will do this all the way to your drawn liquidity. So in this case, you have a drawn liquidity right there. You want to focus on buys. Turtle soup, turtle soup, turtle soup. So for example, you have a drawn liquidity right there. And you see that price doesn't break the lows, but it breaking the highs. You can say to yourself, all right, this is most likely going to reach. Same thing with the downtrend. All the way down, price did not break the highs, but it breaks the lows on the smaller time frames. This is a perfect example when to know when your drawn liquidity will get respected. So how to determine your John liquidity? So market profiles, order flow. Sorry, I did a mistake here. Candle range, range dynamics, daily range, and key levels. So like I said, the most crucial components are determining the market profiles and understanding the order flow and aligning them with key levels and ranges. In this example, the order flow is bearish. Why? Because the highs are getting turtle soup and the lows are getting broken. Market profiles. Here, distribution, range, key level right there, fair value gap. Range inside key level equals expansion. Same thing here. Range plus key level, which is this fair value gap right there, equals expansion. Retracement plus key level equals expansion. All right. Understanding the order flow. Like I said, highs are getting turtle soup, the lows are getting broken, the order flow is bearish. So knowing that, you can predict that your John liquidity will reach somehow. All right. Now, market profiles plus key levels, just like I had explained on the example. All right. Screenshot this, guys. This is going to save you a lot of losses. This is one of the best confirmation. All right. The best, one of the best to confirm that your John liquidity will get respected. So expansion profiles with no key levels equals retracement range. You don't want to trade this. Expansion range plus key level equals reversal. You want to trade this. You want to trade this one and this one. So don't focus on this. Focus on these three. Ranging profiles plus key levels equals expansion. Retracement profiles equals key level equals plus key levels, sorry, equals expansion. Like this example, guys. Range plus key levels equals expansion. Range, key level, expansion. Retracement, key level, expansion. Perfect. Turtle soup plus higher time frame order flow. So if the higher time frame order flow is bearish, the lower time frame will break the highs and turtle soup the lows, like I explained earlier. In other words, when the higher time frame is bullish, price will aggressively push through the highs, but along the way, it will trap liquidity below the lows before continuing upwards. Traders trying to short will get electrocuted as the market sweeps the lows, only to resume its bullish move. If the higher time frame order flow is bearish, the lower time frame will break the lows, turtle soup the highs. Like the example, guys, earlier. All right. Price will drop like a rock in the ocean. The highs will act as a trap. All right. Leaving the lows to be completely destroyed as the market continues downwards. So this is the time frame alignment for the market structure, guys. So For example, your drawn liquidity is on the monthly. You want to look at the daily structure. If your drawn liquidity is on the weekly, then you want to focus on the 4-hour structure. If it's on the daily or the 4-hour, your drawn liquidity, you want to focus on the 1-hour structure. And if you are a scalper, which I do not recommend, 15-minute drawn liquidity, you want to look at the structure on the 5-minute. Perfect. So let's go back. All right. This is a weekly drawn liquidity. That means this is a 4-hour chart right there. This is what I'm using. Perfect. If it's a monthly, then this chart will be a daily. If it's a daily or a 4-hour drawn liquidity, then this chart will be on the 1-hour. All right. Now, the types of range. So you have price range, CRT range, time range, daily range. We are not going to see this. All right. This is a private topic. If you want to see the types of range, go look at the sham CPI. It'll explain everything in there. The important key levels, like I said, the fair value gaps, the order block, breaker block, rejection block, highs and lows. I will show you an example so you can truly understand. So, in this case, we are on USD CAD. This is not a pair I'm trading, by the way. This is on the every pairs, every time frames. This is step by step one you want to look for. So if we go back in there, types of form, you want to look for these. All right, this is the weekly time frame. I'm using only the weekly time frame, sometimes the monthly. All right, but most of the time I'm using the weekly time frame. So I'm looking for highs and lows, CRT high and low, higher time frame PD arrays, and 50% of expansion range or daily range. So now, first thing first, what I see right now. This is a key level right there, a fair value gap, right? So here, this is a drawn liquidity right there. In there, this is a CRT also. This is a CRT. Candle 1, candle 2, candle 3. Now, on the bigger picture, this is ranging, right? This is a big range. So maybe price will continue to do this for several weeks. So this might get respected. And also, this is a key level right there, which acting as a strong support right now. This order block right there, as you see. So it's acting as a support right now. So price might continue to go up. So this is my drawn liquidity. But to make sure it will get respected, we need to look at the market structure and the order flow. All right, so here, right there, the market profiles and the order flow. Let's see what's going on the 4-hour. All right. So in this case, now let's see. So right now, price is bearish, right? So the highs are getting turtle soup. Here, turtle soup. Here, turtle soup. And the lows are getting broken all the time. Here, another turtle soup. And now, what is this? This is a market structure shift right there, right? Sorry. I will write it. Market structure shift. Why? Because look, this is a small retracement right there inside the key level. As you see, a small fair value gap, retracement into the fair value gap. This is the last high that break the last low, and we break it. So now market structure is bullish. All right. Now let's start the week. Thursday, Friday, Sunday, Monday. So let's go on Monday. On Monday. So this is the start of the new week. And that was an opportunity right there. Let me show you guys. So you're looking at the chart right now and it's looking like this. All right? It's looking like this. Knowing that right now we are bullish on the 4-hour, this might get respected. So you want to look for buys right now. You want to focus on buys. Don't try to sell this market. You will get wrecked. All right? So, how to position yourself? Simple. You want to look for turtle soups. Why? Because this is what a bullish market looks like. So this is a low. So you can predict, all right, price will turtle soup and go up after. In this case, you're here, for example, now 9 a.m. Price dumped right there. What do we have? We have a key level in there. And this is an expansion range right there. So you're taking the high and the low. So from the low to the high. Discount, key level, key time, turtle soup. The next target is here. Look. You can look for other opportunities in there. Let's see if we can have some. There's no key level. This is a rejection block right there, but you have a rejection block in there, for example. Price reached. All right. So that might have been a binary opportunity, but in this case, not really. It's no key time. Key level is not clear, so. But this is just an example, guys. Now, for example, you're there. Price reached. Let's go back. You go on the weekly time frame. The next John liquidity can be this, right? This is a PD array or the block. So this is the next John liquidity at this point. And the short-term John liquidity can be this fair value gap, guys, right? So this can be a short-term John liquidity and this can be a long-term John liquidity. Let's see what price will do. John liquidity got reached. Now, for example, where's the next John liquidity? Then you can say, okay, this is a range, expansion range. Can be a dealing range also. Why? Because look, it took out the high, took out the low with a big expansion. So the 50% of this range did not reach yet. Did it reach? Not yet. Very close. So this can be a long-term John liquidity, and we still have this fair value gap as a short-term John liquidity. So let's see what price will do. Market structure, order flow, everything's bullish right now. All right. So what happened here? Still bullish here. Still bullish. Price right there start to be bearish. All right. So this is a market structure shift right there because sorry, this is a market structure shift. This is a market structure shift right there. All right. So you at this point you can focusing on sales. This is your short-term John liquidity and this is your long-term John liquidity. So opportunities. So you can have this opportunity, for example, a turtle soup. And then price break the structure right there. So now price is bullish. So now you're focusing on buys all the way to your John liquidity. So this case, This is why I don't trade this pair, because there's not really good opportunities, right? That was our opportunity right there. Price did not reach yet. Market structure is bullish. Retracement into this fair value gap. Discount to look for buys. And then price smashed the drawn liquidity. Right? This short-term drawn liquidity never got reached. But when you look at the market structure, and when you're focusing on the last highs that break the last lows and the last lows that break the last highs, you can confirm that your drawn liquidity, whatever is the short term or the long term, this is the next target. All right. So the example, your drawn liquidity was the short term one, so you can focusing on sales. Then boom, price start to goes up, so you want to look for buys because this is your drawn liquidity. Price did not reach yet. Retracement, range, inside key level, expansion is coming. For example, all right. So this is how I trade. This is how I'm looking at my drawn liquidities, guys. 50% got reached. The next one is this. For example. And this is a short-term drawn liquidity. Here you go. Drawn liquidity got reached. All right. So this is it for this video. All right. This is it for this video. I did a live call with my community. I did the live call. It's like a 2-hour video, and I'm showing a lot of example based on this. All right. If you want, take a look at this. I will post the video here, right there. Look at it. I'm explaining what I just teach you right now to all the students. This is not my students, this is my community, because this is free. But yeah, I'm explaining and I'm showing for 2 hours straight. I'm showing a lot of examples on multiple pairs. So if you want to see more examples, more detailed, take a look at this video. All right. So this is it. Thank you very much. I hope you enjoyed. Take notes. And see you next time.